Let's get things started with CNBC's senior markets correspondent, Bob Pisani. Also with me is the Wall Street Journal capital markets reporter, Corrie Driebusch. Bob, let me start with you. This Silicon Valley Bank, I saw the headline is Peter Thiel sort of started this, and he's obviously a pretty big tech in Silicon Valley, I guess, if you will, capitalist or tech investor, if you will. What made him do this? Because it seemed to trigger a run on this bank.
Well, there's larger concerns here. So Silicon Valley Bank is a very peculiar kind of animal. It's not a typical regional bank that we see. This was very involved in the innovation economy. These startups were very involved, and the bank was very involved with the startups, providing lending and support. So a lot of these startup companies in Silicon Valley had deposits there. And for example, they were using those deposits to make payroll. In the last 6, 8, 9 months, we have seen real difficulties as interest rates rise. These startups don't make any money, so they have to constantly be borrowing money. It's been tough to do that. So instead of doing that, they've been selling down or going into their deposits and essentially using that to fund their operations. Well, the banks noticed this and saw a dramatic drop in their deposits. This didn't happen everywhere else except here, and they had to sell some assets to deal with those deposits going out. So what they found was they had to sell bonds that had dropped in price, and that's what got everybody attention. So I don't think it's not necessarily Thiel that's dealing with this. There's a larger problem here with the fact that Silicon Valley has had problems not being able to fund their operations because they can't borrow as easily, and they're drawing down the available cash. So again, this is a pretty particular situation right now.
So it sounds like what you're saying is that that now that the free money train is over, thanks to the Fed and the interest rate hikes, I mean, are we going to find out that there are a lot more of these Silicon Valley startups that maybe aren't what we thought they were, and they're about to be caught with their pants down here next week?
Well, that's a contagion question, and the answer is I don't know, but I tend to doubt that. I'll tell you what the real issue is. The real issue is related to this issue, and that is that the costs of deposits are going up. My mother called me 2 weeks ago and said, Robert, I'm taking money out of my bank account and I'm buying bank CDs and 2-year treasuries at 5%. Why shouldn't I do that? Well, people around the country are doing what my mother's doing. They're taking their bank deposits and they're buying CDs and short-term government treasuries. That means deposits are going down in a lot of these banks. The banks are going to have to pay their depositors more money. What that means is there's going to be a hit to earnings. It's going to be a cost, and that's good for the depositors. My mother's going to be very, very happy, but it's a hit to the bank earnings. That's a separate question. It's related to that Silicon Valley Bank question, but it's a related question, and that's one of the reasons the banks have had a lot of problems this week, independent of this.
All right, let me bring in Corrie Driebusch here. So, Corrie, the near term, Monday morning, what are you looking for to see? Is this contagious or not?
Well, I think on Monday, so what the FDIC has said, that depositors will have access to their funds by Monday. So I think we have to see what happens. I know that a lot of my conversations right now is with startup fund founders who had money at Silicon Valley Bank, and some saw the writing on the wall yesterday and were pulling their money out and transferring it to other accounts. But that means you had to have an account open, typically at another bank, to be able to move your money or do a wire transfer. Others have millions of dollars still tied up, and that's above the insured amount. So I think everyone is in a little bit of a panic mode right now that I've been talking to, trying to figure out what's going to happen. And when people are panicking, they sometimes do maybe not rational things.
Well, I was just going to say, what is something the FDIC could do to almost prevent the irrationality?
Oh, maybe Bob can answer that better than I can. I'm not sure. I think what everyone was hoping for last night into the very late hours was that the share sale that SVB was attempting to do with that, if that was going to go through. Because really, when you think about it, they had a couple $1 billion hole they needed to fill. And if they'd been able to do this capital raise by selling additional stock, and they'd been able to raise that money, that would have calmed a lot of investors and would have calmed depositors to know that things were okay and that could have continued. When it came this morning and news broke that the bank was unable to complete that stock sale, that capital raise, that was a real tipping point.
Bob, what does it say? You know, I remember during the 2008 financial collapse, I think it was JP Morgan said, yeah, we'll take Merrill Lynch. Why wouldn't some of the bigger banks why wouldn't they want to take on SVB? I mean, that to me is a bit of a yellow flag, is it not?
Well, the answer is be careful, because what happened in 2008 and 2009, it was Bank of America, as I call it, Merrill Lynch. But the important thing is all of a sudden, these banks took on some very big liabilities potentially. And a lot of things, when you lift the rock up, a lot of things you discovered here. Now, in theory, Silicon Valley Bank has more assets than it does liabilities. I saw $200 billion in assets and $175 billion in deposits. Deposits are liabilities. So in theory, you're right. We should be able to find a seller for this, hopefully, a buyer for this, hopefully over the weekend. And that would alleviate a lot of concerns here. However, it may take longer than that in this kind of environment. In theory, there's plenty of assets here, and people can be made whole. If that doesn't happen, you've got a problem. The FDIC only insures up to $250,000. Now you've got a government decision. Is the bank too big to fail?
Right. Well, let me ask you that. Is it too big to fail?
I was just going to note that about the assets. Yes, it had 175 billion assets, but there's been a lot of taking out. A lot of people have been taking out their money. So that's what I've been hearing also in conversations about, do you want to take on Silicon Valley Bank's assets right now? There's not, if everyone's leaving, what are you buying? Does that make sense?
It does. I see what you're saying there, if everybody's already fleeing. All right. Bob Pisani, Corrie Driebusch, thank you for trying to help us understand this, get us started, and we will all cross our fingers through the weekend.
Thanks for watching our YouTube channel. Follow today's top stories and breaking news by downloading the NBC News app.